Hey there, I'm Saida Garrett-Guest, financial strategist and educator, here to help you make smarter money moves. If you want to build wealth, protect your assets, and retire stress-free, you are in the right place. I'm going to be breaking down concepts like life insurance, retirement planning, annuities, estate and legacy planning in a way that actually makes sense. So if you are ready to take control of your financial future, go ahead and hit the subscribe button and let's get started. If you think life insurance is just about dying, you're missing the bigger picture. What if I told you that the right policy could help you build wealth, retire tax-free, or even act as your own personal bank? Let's break down the different types of life insurance and which policy may be the best for you. Most people only hear life insurance and think about covering funeral costs. But the reality is life insurance is more than just about protecting your loved ones when you're no longer here. It's actually a powerful financial tool that you can use while you're still alive. So whether you're looking for the most affordable policy or a plan that can help you build wealth over time, I'm going to break down and simplify all your options so you know what choice is best for you. By the end of this video, you'll know which type of life insurance best fits your needs, whether it's the cheapest option, the one that helps you build tax-free growth, or just provides guaranteed security. So let's go ahead and dive in. So when it comes to life insurance, the first thing you want to figure out is how much coverage you actually need. We call this your insurable need, or the value that you bring to your family. So to do this, we use a method called the DIME method. The D stands for debt. So most people think that when they go away, their debts go away. But truth of the matter is your debts actually pass on to your next of kin, whether that's your spouse, your children, or even your parents. So when you're looking to calculate this number, you want to first start with your debts, which includes credit cards, private student loans, and any loans that you may have, such as car notes. The I stands for income. And so when you're thinking about your income, you want to think about how can I protect my income producing ability? Now, there's normally two types of people that fall into this category. The first category is going to be a person who multiplies their income by a factor of 5. So your annual salary times a factor of 5. This is for the person who solely depends on their income by themselves. No one else depends on it but them. They're looking to maintain their independence. God forbid they get sick or disabled. They don't want to go live with anybody. They want to go to the best facility if they have to go to. They don't want to smell any pee or urine. You understand what I'm saying? So you're going to take your annual income and times it by a factor of 5. Then you have people who fall into a category where they want to times their income by a factor of 10. So these are individuals who have other people depending upon their income for their lifestyle needs. So this could be a husband or wife, this could be children, this could be an aging parent, or even somebody that has disabilities. So you take your annual income, times it by a factor of 10, so that if something were to happen to you, their lifestyle would not be impacted. The M stands for mortgage. So if you have a mortgage, you have to ask yourself, do I want the bank to come pick up my property if I'm no longer here? That amount of money that you have left on your mortgage, your life insurance helps pay that off, so that way your family can maintain the home. And finally, the E stands for education, emergency fund, or etc. This is the amount of money that you want to leave behind to help pay for your kids to go to college if you have young children, that you want to help your family establish an emergency fund, or just leave for whatever you desire them to do, such as establishing a legacy and building generational wealth. So now that we understand how much insurance you actually need, you have to figure out and decide how much you actually want to purchase. And that's between you and your family. But I will say the average American family needs about $1 million worth of coverage. And that's based on a 2-parent household earning $50,000 each. So once you decide how much coverage you actually want to purchase, our next step is to decide how you want to fill that need. And there's 2 ways you can do that. You can either meet that insurable need with a temporary insurance, which we call term, or you can meet that need permanent, which we call permanent insurance. So I'll start with term first because it's the easiest to understand. Term insurance is like renting your insurance. You do not own the policy, but you are able to rent it for a period of time. 10, 15, 20, 25, 30 years. Think of it like renting an apartment or renting your home. You pay for that apartment or that policy for a period of time, and at the end of that lease, at the end of that time period, you have 2 options. You can decide if you want to renew it. Now, if you do decide to renew it, the cost typically does what? It goes up. Or you can decide to say, you know what, it served its purpose, and you can let it go and you walk away with nothing at that period of time. Now, I know a lot of people are going to give term insurance a bad rep, but hear me out. Term helps you cover and protect things where you can get a lot of coverage and insurance for pennies on the dollar. It is the most affordable type of insurance. I like to call it the Wendy's 4 for 4. So think about if you have young or small children, or if you still have a lot of debt, or you have a large mortgage, you can get millions of dollars worth of coverage for pennies on the dollar to protect and cover you. So is it a waste of money? No, but you have to understand how to use it and what to use it for. It's to protect and cover you for temporary needs. Plus, they have what we call the new type of term, where you have term life insurance that can give you living benefits, meaning that if you were to get any major critical, chronic, or terminal illness, you can use that insurance coverage to help pay for any medical needs, expenses that you may have. And you have what's called convertible terms. So even if you are in a place financially where you don't have a larger budget, but you need a lot of coverage, you can purchase that policy and then you can convert it to a permanent policy as your finances or situation change later. So that's term insurance where you are renting. The second way you can cover this need is what we call permanent insurance. Now, permanent insurance is like owning a home. So the same way where you own a home, you're owning an asset. So it's going to cost you a little bit more to get into, but once you're in it, it's yours for the rest of your life. Nobody can put you out as long as you're paying your premiums every single month. In the same way your home can appreciate in value, your policy can appreciate in cash value. So you now own this asset. Now, when you own this asset, there's two different ways you can do that. The first type of permanent insurance we call is whole life. And whole life is what I call the OG or the original gangster of life insurance. So I'm going to break down how whole life policies work. Whole life insurance is very simple to understand. The company is going to tell you how much premiums you pay every single month, how much the death benefit is going to be, and how much interest you're going to earn from that policy. So a lot of people like whole life because it's very easy to understand. It's not complicated. Now, with whole life, because they tell you how much the premiums are, how much the death benefit is, and how much the interest works, it is what we call a fixed policy, meaning that once you set it up, you cannot make any changes to that policy. Otherwise, the life insurance company would not be able to guarantee you the amount of interest, cash value, or death benefit that you have. So once you set it, you cannot change how much premium you add to it. You cannot change the death benefit amount on it, nor can you change how much interest it earns, but it works. Now, because whole life is fixed and it has those guarantees, it is the most expensive type of life insurance, so you should note that. The second type of permanent life insurance is what we call universal life insurance. So universal life insurance is like the answer or the upgrade to whole life. So while people like the fact that whole life is simple, they do run into issues with it because unlike whole life, life is not fixed. It has variables that go ups and downs. And so people run into issues where they may not be able to keep that coverage or maintain that coverage because of life changes. So universal life insurance gives people flexibility. It gives them the options. Now, I know what you're thinking. I know you're saying, Saida, I like options. But sometimes, if we're honest, options can be overwhelming. So let me break down how universal life insurance works with all the options so that you can have clarity in deciding which policy is best for you. So universal life insurance is going to give you options and flexibility across a various of factors. And because it offers flexibility, it is more affordable than whole life. Still more expensive than term, but it's more affordable than whole life. So here are the options that universal life insurance policies ask you to decide. The first option that you have to choose is you have to decide if you would like to have death benefit only or if you would like to have death benefit plus cash value. We call this level or increasing. So death benefit only means that whatever death benefit you purchase, if there is a cash value accumulation inside that policy, no matter what that cash value accumulation is, your family will only ever receive the death benefit amount that you purchase. So if you had $100,000 death benefit, the cash value is $50,000. Upon your death, your family would receive $100,000. That's the same way whole life works. It's fixed, it's level. But Universal also gives you the option if you want to have death benefit plus cash value. So in that same scenario, if you purchased a $100,000 policy, the cash value was $50,000. Upon your death, assuming you never took that money out, your family will receive $150,000. So you have to ask yourself, do I want death benefit only? Or would I like to have death benefit plus cash value? The second option that you're going to choose is how you want the interest to be credited to your policy. So in whole life, remember we said the interest was fixed. So whatever interest rate you purchased that policy at, it stays that rate for the entire duration of the policy. In universal life, you're going to choose. So money grows three different ways. You can choose to have fixed interest, meaning that every single year, the life insurance company is going to declare how much interest they're going to pay you for that policy. So this year, it may be 4%. Next year, it may be 5%. The following year, it could be 6%. But what it does, it allows the life insurance company flexibility that if they're making money, they can pay you more. But if the economy is going a different way, they can pull back a little bit on that interest. The second way you can choose to have interest credited to your policy is what we call variable. So variable means that your money is directly invested in the stock market. So you're going to choose which type of mutual funds or sub-accounts to place your money in. When the stock market goes up, you can make 100%. But if the stock market goes down, what can happen? You can lose 100% as well too. So you have to have a risk tolerance. Now, I want to note, variable life insurance is the only type of life insurance that is an actual investment account. The third type of interest that you can choose from is called index. Now, index is where you have market-linked gains, but your money is not directly invested in the stock market. So let me explain. If the stock market goes up, you can make money. But if the market goes down, you don't lose any money. Your gains just lock in and coast until the market makes money again. So if you think about index, it almost looks like stair steps. When the market goes up, you make money. The market goes down, you lock in and coast. Up, you make money. Down, it locks in and coast. So it allows you to still earn on average between 8 to 12% returns without ever having to worry about losing money in the stock market. So you have to decide, do I like my money to grow fixed, which comes out to be about 3 to 4% on average? Do I like my money to grow variable, which you can make 100%, but you can also lose 100%? Or would I like my money to grow index, where I can average 8 to 12% rate of returns without ever have to worry to lose money in the stock market? So now that we decided how you want the death benefit to be, we decided how you want your interest to be credited to your account, the last thing we have to decide is how much money you want to pay for this policy. Yes, you heard me right. Universal Life Insurance offers what we call a flexible premium, meaning you decide how much money you want to put into this policy. Well, not exactly. Let me explain. So in universal life insurance policies, they offer you what's called a flexible premium, which gives you a range, a minimum that you can pay every single month for that policy and a maximum that you can pay every single month for that policy. And that funding range is based on the amount of death benefit that you actually purchase. So if you purchase $100,000 of death benefit, your minimum will be lower, but your max will also be lower. If you want to purchase $100 million of life insurance, your minimum will be higher, but your max will also be higher. So when you're deciding how much money you want to contribute to an account like this, you want to make sure that you're somewhere in the middle of the minimum and the max, which is based on the death benefit. Now, your agent or advisor is going to be able to help you decide what death benefit is right for you so that you can maximize this policy. But what it allows you to do is that when times are good, guess what? You can put more money into the policy. And then when times are bad, or maybe they switch up, because we all know life happens, you can pull back a little bit. And it gives you that flexibility that whole life doesn't provide. So those are the options that you have to make. How do you want your death benefit? How do you want the interest to be accredited? And then how much money would you like to put inside of this policy? So we covered two different ways that you can cover your insurable need. All term, which is going to be the most affordable. Permanent, which is going to cost you a little bit more, but you own the asset, is yours for the rest of your life, and you can decide between whole life or universal. But here's the thing, there's a third option that most people never talk about. We call this option a blend, meaning where you can cover your insurable need with part term and part permanent. This helps you optimize your costs by covering part of it with term to keep it more affordable, but it also helps you actually own an asset, build cash value and wealth over time by using the permanent option. Let me make it simple for you. Let's just say your insurable need was $2 million. So you decided to do $1 million in term for 30 years and $1 million in permanent. Over that 30-year time frame, you would have a combined coverage of $2 million. So if you have young children or a mortgage or debts, it allows you to cover yourself that if something happens, your family will be okay. Now, at the end of that 30 years, you get to decide, do you want to convert that term policy or do you want it to fall off? Let's just say you want it to fall off, you no longer need it. The house is paid off, the kids are grown, all the debts are covered. That means you would still have $1 million of permanent coverage that has built up cash value and accumulation over the past 30 years. So it's possible, depending on which type of policy you chose, how you selected that interest to be credited to your account, it's possible that that $1 million can now be valued at $1.5 million, $2 million, or even more, just depending on how that policy worked for you. So you were able to optimize your costs, keep them low, but still build wealth and leave a legacy for your family. So when you're deciding which type of policy is right for you, I want you to consider a few things. The first thing is, what are your goals? What are you trying to accomplish? If you need a lot of coverage, maybe term could be good for you. If you're in a place where your finances aren't where you want them to be, term also is a viable option, because hear me out. The best type of insurance is the insurance that works when you need it. Now, if your goals are more so focused on building cash value, retiring tax-free, being able to become your own bank, well, then you need to consider permanent options, because they're the only options that have cash value. And so in doing so, is it a whole life policy or maybe it's a universal life policy? That's going to come down to the types of strategy you use, which we'll cover in another video, but you are the one who gets to control what it is you want to see from your insurance. Or here's the thing, you can do both. It doesn't have to be one or the other. It doesn't have to be a battle. It's really about what your goals are, what you want to accomplish. So I hope this video helped. I hope you learned a lot. I hope you understand now what your options are, how much insurance you need, how you want to fill that option, and then which policy you need to choose that works best for you and your family. So if you enjoyed this video and you want to learn more, make sure you subscribe to our channel, and I'll see you in the next lesson.